Enron Corporation was formed in 1985 through the merger of Houston Natural Gas and Internorth, two energy companies, seeking to consolidate operations and expand into new markets. Under the leadership of Kenneth Lay, Enron pursued aggressive growth strategies, initially focusing on traditional natural gas and electricity distribution. The company's headquarters were located in Houston, Texas, and it quickly became a key player in the U.S. energy sector. In the early 1990s, Enron began innovating in energy trading, ultimately creating the Enron online platform in 1999, which would revolutionize the buying and selling of energy commodities. The firm expanded internationally, investing in power plants, pipelines, and infrastructure projects across Latin America, Europe, and Asia. Enron cultivated a public image of visionary leadership and financial acumen, drawing admiration from investors, media, and political figures alike. By 1998, Enron had transformed from a traditional energy company into a trading and investment powerhouse, with reported revenues exceeding $40 billion. The company's culture emphasized risk-taking, innovation, and financial engineering, laying the groundwork for both its rapid rise and eventual collapse. During the late 1990s, Enron's stock price soared, peaking at over $90 per share by mid-2000. Executives, including CEO Jeffrey Skilling and CFO Andrew Fastow, embraced complex accounting techniques to present continuous growth and profitability. Special purpose entities, SPEs, and off-balance sheet partnerships were used extensively to hide debt and inflate earnings, creating a facade of financial health. Enron's corporate culture became synonymous with aggressive ambition and bravado. High-profile projects, such as broadband ventures and international energy contracts, were heavily promoted, often masking underlying financial vulnerabilities. Analysts and media praised Enron as an innovative juggernaut, and its executives became celebrated figures in business circles. Despite outward appearances, internal warning signs emerged. Some employees questioned accounting irregularities and unusual financial structures, while external auditors from Arthur Andersen were criticized for inadequate scrutiny. The company's reliance on creative accounting created a fragile framework, vulnerable to market shifts and investor skepticism. In 2001, cracks in Enron's financial reporting began to surface. In October, the company announced a $618 million reduction in reported earnings, triggering a sharp decline in stock prices. Investigations revealed that off-balance sheet entities had been used to conceal massive debts and losses, fundamentally misrepresenting the company's financial position. By December 2001, Enron filed for Chapter 11 bankruptcy, marking the largest corporate bankruptcy in U.S. history at the time. Thousands of employees lost their jobs and retirement savings, while investors suffered billions in losses. The scandal also led to the dissolution of Arthur Andersen, one of the Big Five accounting firms, due to its complicity in auditing Enron's misleading statements. Legal proceedings followed, resulting in the conviction of executives including Skilling and Fastow. Kenneth Lay died before sentencing, leaving a legacy of controversy and prompting significant regulatory reform. The Enron scandal became a watershed moment in corporate governance, prompting widespread reforms. The Sarbanes-Oxley Act of 2002 introduced stricter auditing, financial reporting, and corporate accountability standards in the United States. Educational programs, industry best practices, and public awareness campaigns emphasize transparency and ethical responsibility in business management. Culturally, Enron serves as a cautionary tale of unchecked ambition, corporate deceit, and the consequences of prioritizing short-term profit over long-term integrity. Documentaries, books, and case studies continue to analyze the company's rise and fall, examining systemic weaknesses that allowed such a monumental collapse. Enron's story remains a stark reminder that innovation and success can be undermined by ethical lapses, and that vigilant oversight is essential to maintain trust in financial markets and institutions. Watch even more incredible stories on our channel. Subscribe to our channel so you don't miss a new episode of rule-changing stories.